Welcome to vTalkInsight Allocator's Lens Daily for December 17th, 2025. Cross-asset markets are being pulled between an AI-driven Capex boom, a steepening yield curve, and powerful demand for safe havens like gold, all while volatility stays relatively contained. Let's start with equities, where that tension between growth optimism and tight risk premia is most visible. In equities, the central story is still an AI and Capex supercycle colliding with late-cycle macro dynamics. Expectations are building that investment in artificial intelligence will matter more for markets than traditional macro data through 2026, with major tech firms collectively targeting trillions of dollars of Capex over the decade. That spending sits alongside supply-side signals that U.S. growth could exceed 4% next year in an earnings narrative where double-digit corporate profit gains, rather than more rate cuts, are expected to drive index-level upside. Forward-looking calls remain upbeat. Many houses see U.S. equities delivering around 10 to 12% upside into 2026. Some base cases put the S&P 500 near 7,500, and in a more aggressive easing scenario, some even point to levels above 8,000. That optimism is backed by specific growth stories in cloud and software, from platforms like Amazon's Web Services and ServiceNow to data infrastructure names such as Databricks, all of which are leaning into AI-driven demand. At the same time, management teams face pressure to show both growth and free cash flow, which is already feeding a pickup in large-cap tech M&A and should keep the market highly selective about who the long-term winners are. The flip side is that valuations and concentration are clearly stretched. The S&P 500 is trading around 23 times next year's earnings, a level last seen at the turn of the century, while a small group of large-cap U.S. names now represents roughly two-thirds of total market capitalization. Individual leaders, such as Google, have seen their valuation multiples roughly double in a short period on the back of 20% growth assumptions, and AI infrastructure players are committing to Capex paths that will require very strong revenue capture to be justified. Today's message is not that this is an obvious bubble, but that even a pause in expensive technology stocks, similar to past non-bubble drawdowns, could matter a lot for index-level returns given how concentrated capital allocation has become. Beneath the surface, there are healthier signals as well as warning lights. Market breadth has improved sharply, with a majority of S&P constituents outperforming the index over the past month, and flows have rotated toward equal-weighted indices and cyclical value sectors, such as financials, industrials, materials, and even utilities. Energy remains heavily under-owned relative to history, even as allocations to commodities rise, while many energy and commodity producers are prioritizing buybacks and dividends over aggressive expansion, which can improve equity risk-reward if sentiment turns. Positioning, however, looks very full. Global fund manager cash is down to around 3.3%, the lowest on record, which historically has coincided with slightly negative 4-week equity returns, and options markets show investors selling volatility even after a choppy, slightly negative stretch for the index. Volatility indices remain in the mid-teens, and hedging is relatively cheap, but most demand is short-dated and tactical, leaving limited protection if correlations jump. Key risks to watch are the Federal Reserve potentially halting rate cuts earlier than equity investors expect, a re-acceleration of inflation from simultaneous monetary and fiscal stimulus, and signs that weaker holiday, spending, or labor market data start to challenge the earnings resilience narrative that underpins current multiples. Turning to rates, the dominant feature is a steepening Treasury curve that reflects both easing hopes and stubborn term premia. Short-dated yields have been drifting lower as markets price 1 or 2 further cuts next year, while long-dated yields remain elevated, with the 30-year bond hovering near 5% in several recent snapshots. That pattern, seen in both the 2 versus 10-year and in longer maturities, suggests investors expect the Fed to trim policy rates, but remain concerned about growth durability, inflation persistence, and heavy fiscal issuance. Policy signals add to the tension. On one hand, the Fed is still expanding its balance sheet to address reserve shortages, and liquidity conditions are rated as the most supportive since the early post-pandemic period. On the other, simultaneous monetary and fiscal stimulus outside a recession is historically unusual, and inflation is still above target, with business surveys indicating that firms plan to keep raising prices through 2026. Inflation swaps have fallen, which implies markets may be underestimating the risk that tariffs, fiscal looseness, and abundant liquidity trigger an inflation surprise that forces the Fed and other central banks into a more hawkish stance. Positioning in fixed income reflects that uncertainty. There has been a significant rotation out of bonds, leaving allocations to fixed income at their lowest since late 2022, even as flows into short-dated paper increase as insurance against a deeper cutting cycle. Large asset managers are openly cautious on the long end, citing U.S. fiscal dynamics and higher term premia, while central bank projections show only very gradual easing, with many officials expecting one or fewer cuts by 2026. With interest rate volatility expected to rise over the next 6 months and Fed plots showing wide internal disagreement, upcoming labor and inflation data, as well as the eventual choice of the next Fed chair, will be critical catalysts for the curve and for how attractive bonds look relative to equities. In credit, public markets remain open and spreads are tight, but the forward balance of supply and demand looks more delicate. Corporate borrowing is rising as companies fund ambitious AI and infrastructure investment plans, and if that issuance pace persists, it could start to pressure spreads and create pockets of indigestion, especially in longer-dated or lower-quality paper. A steepening yield curve helps financial sector earnings, yet also raises the marginal cost of capital, which can matter for heavily leveraged issuers tied to the Capex cycle. Alongside that, private credit continues to grow rapidly. Retirement investors are increasingly attracted to the illiquidity premia on offer, and managers see substantial room for expansion, even as concerns about transparency and risk management in this less regulated space remain. Private markets more broadly are busy. Global M&A volumes are up around 40% to roughly $4.5 trillion, dominated by mega deals, and a revived IPO calendar led by offerings like Medline signals improving conditions for exits. Still, ongoing geopolitical tensions and uncertainty over the timing and scale of future rate cuts mean transaction volumes could be sensitive to any macro setback. Real assets linked to credit are also drawing allocator attention. Commercial real estate prices remain about 20% below their peak, even as equities and bonds have recovered, leading some investors to rotate into property where they see better value, particularly in rental housing and manufacturing-oriented logistics tied to supply chain rewiring and fiscal incentives. At the same time, climate-related catastrophe losses are projected to exceed $100 billion globally, with the vast majority in the U.S., prompting insurers to push clients toward risk mitigation and potentially reshaping how catastrophe risk is priced and transferred across insurance-linked and structured credit markets. Foreign exchange markets are increasingly central to the cross-asset picture. This year, broad dollar indices are down roughly 8 to 10%, with most of the weakness versus Europe and Latin America, reflecting both the Fed's easing bias and a perception that global growth outside the U.S. can hold up. That backdrop has supported high-yielding carry trades and risk-sensitive currencies, such as the Australian and Canadian dollars, especially while volatility stays contained. However, the outlook is not one way. Some scenarios foresee early-year dollar softness followed by a renewed bout of strength mid-year as markets fully price the Fed cutting cycle, which could pressure emerging market currencies. Regional stories add more nuance. The Chinese yuan is seen by many as significantly undervalued, with a large trade surplus and policy interests pointing toward gradual appreciation over time, which could support parts of emerging Asia if delivered in an orderly way. By contrast, sterling is expected to underperform other European currencies because the Bank of England may end up cutting more aggressively than futures imply, given softer labor and inflation data. For allocators, that mix of a structurally weaker but tactically volatile dollar, a potentially firmer yuan, and a lagging pound reinforces the importance of policy divergence and balance of payments in FX returns. Digital assets intersect with FX in interesting ways. Bitcoin is currently finding support near $84,000, a level close to the average break even for many exchange-traded funds. A decisive drop below that area could trigger further ETF outflows and amplify downside, even though a weaker dollar and easier U.S. policy are seen as medium-term supports. At the same time, real-world usage of blockchain and stablecoins is accelerating, with networks like Visa reporting multi-billion-dollar annualized settlement volumes and building unified platforms for clients to manage both fiat and stablecoin payments. Tokenization of highly liquid assets, such as U.S. Treasuries and cash equivalents, is gaining momentum, helped by regulatory clarity and the entry of major asset managers, which may gradually reshape how investors hold and move their defensive liquidity. Commodities round out the cross-asset story with a mix of near-term disinflation and longer-term scarcity themes. Brent crude has fallen towards $60 per barrel, with some participants expecting a move closer to $50 as markets price a potential ceasefire in Ukraine, OPEC discipline fatigue, and record non-OPEC production into what looks like an oversupplied market. Gasoline prices are projected to trend toward $2 per gallon nationally, and broader commodity prices, from oil to natural gas and agriculture, are under pressure from abundant supply and technological advances. That combination is a powerful disinflationary force, giving the Fed more room to be accommodative and supporting energy-intensive sectors such as airlines and parts of industrials. Yet the structural picture, especially for energy, is more complicated. Underinvestment in upstream oil and gas, particularly natural gas, is expected to limit future supply growth, just as AI-related electricity demand in the U.S. is projected to account for roughly half of all power demand growth this decade. On an energy equivalent basis, U.S. natural gas prices already exceed oil, and while weather still dominates short-term gas volatility, rising data center and liquefied natural gas demand underpin a much firmer long-term floor. Against that backdrop, many commodity and energy companies are emphasizing shareholder returns over capacity growth, which can support equity valuations but also leaves less buffer if demand surprises to the upside. Industrial and precious metals highlight the same tension between growth and risk hedging. Base metals, such as copper and aluminum, are expected to outperform traditional safe havens as cyclical demand, grid upgrades, and competition for power from sectors like data centers all support consumption. At the same time, gold is enjoying its strongest year since the late 1970s, boosted by renewed ETF inflows and central banks that have doubled their annual purchases to around 1,000 tons, providing a steady, price-insensitive demand source. U.S. private investors still hold very little gold, so even modest allocation changes could move prices, especially if concerns about dollar debasement or geopolitical risk intensify, a theme echoed by Europe's step change in defense spending even as defense stocks wobble on intermittent hopes for peace in Ukraine. Across assets, the picture remains late cycle but still skewed toward growth, powered by an AI Capex boom, supportive liquidity, and a broadening equity rally, yet framed by elevated valuations and very tight risk premia. Steepening yield curves, sticky inflation risks, and the prospect of more volatile policy outcomes argue for watching interest rate markets as the key transmission channel, with knock-on effects for credit spreads, FX trends, and equity multiples. At the same time, cheaper oil and abundant commodities are easing near-term inflation pressure, while structural forces in energy demand and central bank gold buying keep the longer-term case for real assets alive. For allocators, the main tasks now are track how quickly AI investment translates into earnings, how the Fed balances easing against inflation and fiscal realities, and how the dollar and gold respond to any surprise in that macro mix. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.